Hi, I'm Peter Rose, founder of Longwood Currency Trading. I'd like to revisit a video that I did about a week ago on there are no Forex trade setups. I had a lot of really nice comments and emails about that and a lot of readership or watching viewers for the video. So I think it struck a chord with everybody. But a lot of the emails that I'm getting have more questions than I think I probably should have gone into a little bit more in that video. I mean, it was more like an opinion thing as to why there are no Forex trade setups. I think the setup is within you as the individual trader, is that you understand trading so that when you look at price action and based on your knowledge of that price action and that particular currency pair and the economics of the situation, just your experience, you go, oh, it looks like this could be a time to get in to enter enter a position at this time. I didn't really go into the decision-making process of that to show that there were no trade setups. I showed how you go about maybe just kind of generally reviewing trading as opposed to relying on these mechanical things that really don't make any sense. The key to understanding what I'm saying when I indicate that there are no Forex trade setups is that if we look at, and I use the engulfing candle pattern, which is fairly indicative of a type of order flow that's kind of confused at that particular point, and it could create a change in direction. But not all of those patterns, engulfing candle patterns, are indicative of a change. If you look at a chart where somebody is talking about engulfing candle patterns and they pick one and they say, oh, see, this is what blah, 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 and this is what happened, if you go back in that chart, you'll find similar engulfing candle patterns that they did not choose. So it isn't the candle pattern that's creating the setup, or it isn't the whatever it is that you've decided, the XYZ super booper blinding Forex entry point trick. There isn't any of that. It's your evaluation of the situation. Listen, when you're looking at how price is moving, there are a lot of people that use Fibonacci's, for example. And I don't believe in Fibonacci's. Look, I got a degree in physics. I believe in Fibonacci's, but they have nothing to do with trading. Where is the direct correlation between a Fibonacci level and what order flow price action is doing? Where is the correlation? You know, you can form a correlation in a Fibonacci as to tree rings, and you can count the age of the tree ring or certain population growth patterns in certain species, but there are correlations to why that happens. But there's no correlation between a mob of traders that are making random decisions paired off against each other in a zero-sum game. There's no correlation between that action, that market, and a Fibonacci level. There isn't. And yet a lot of people will use that as a setup. Or they'll say, oh, when the fast MA crosses up over the slower MA and it has a fib level of 68 point whatever, and the RSI is XYZ, then that's my setup, and I'll go in and take the trade. But all those things have absolutely nothing to do with what's going on right now. Every indicator that's out there is based on what happened in the past. Do you realize that when you look at a point on a price action chart where the price is right now, that it is 100% 50-50 jump ball whether that price tick on the next tick is going to go up or whether it's going to go down? and it's 50-50 whether it's going to go up or down on the next price tick. You only get these trends after the fact. You can't determine at the beginning of a trend that you're going to be in a trend. It sort of has to prove itself out. And so many times, particularly now in these larger markets, but in the currency market, there are no real long, consistent trends that aren't interrupted by major retracements. So you can say, oh, I'm going to get on one of these big trends. Well, we're looking right now, this is mid-February of 2023, and you can look back over the past month and a half or so. Pound dollar chart, for example, has been hugely positive, probably 500 pips. It's going up in a positive direction. But there have been some major retracements. And now it's back down, it's come back down 300 or 400 pips. But there have been 200 pip retracements. So taking advantage of these long-term trends is kind of self-defeating. Back in Richard Dennis's days when he was doing commodities, there were these long trends. They were seasonally based, but they were really long trends. And they were predictable to a certain degree because you grow wheat in a certain season, in a certain period, and so it's in demand. But there's a lot of it, and so there isn't so much wheat when it's out of season. And so, I mean, you know, you can have some predictability to those movements. And even he says, or he said, maybe 10 years ago, you know, my systems before probably wouldn't work today because there are no predictable long-term trends, or when there are long-term trends, they're interrupted by massive retracements. So if you think you're going to get on a trend that's going to go 700 pips, it may go 700 pips, but somewhere along the line there, it's going to come back 300 or 400. So what are you going to do? Are you going to sit there and wait, as Richard Dennis's Turtle Group did? They would wait 4R for a retracement before they would exit the position. That's a huge amount of money to lose of what was made. And yet they made a tremendous amount of money. But they were sitting with these positions sometimes for 2 years, 8 months. And again, you could sort of predict the likelihood that you were going to hit that 4-hour retracement within the period prior to it going up 4-hour or 5-hour or 6-hour or 8-hour, and then you get a 4 pullback. So you close out and you get 4-hour. Okay, that's a good return. But is it for the amount of time that you put in to staying with that trade as a percentage of the amount of money that you've got invested and the fact that you withstood this 4-hour retracement? Well, the money doesn't belong to you until you close the trade, right? But let's look realistically at how the trading process goes and what price action represents and how price action is affected and is a direct cause-effect relationship between order flow, and order flow is dependent on the major constructs in the Forex market to interest rate differential between the two pair countries. That's the primary one that you base that on. And then you have the minor ones, the CPI and political stimulus and all the rest of the stuff that go to make up the economic situations in that country pair, or each pair of that, each member of that pair. So how, in anyone's wildest mind, that they can teach a setup in the currency market is beyond me. Because there's no correlation between whatever it is that you're doing and what that price is going to do next. There's probabilities for that happening, in which case you're not talking about a setup. You're talking about what I term entry analysis phase of the life cycle of a currency pair. This is these are terminologies that I've come up with based on my 33-year career as a senior software engineer, decomposing complex problems into manageably solvable pieces. And so I've taken the life cycle of a currency pair from the time that you put the first trade on of the position until you close out and you're flat on that particular position. That's the life cycle of the currency pair. And there's 3 phases of that cycle. You have entry analysis, position management, and exit methodology. Doesn't that make sense? Who teaches that shit? Nobody. And in each phase of that, you have 3 questions. What is it that I could do? How do I do that? And the most important one, that again nobody seems to get a clue of, is when do you do that? Nobody's mentioned that before. The life cycles of the currency pair and that, what, how, when, nobody's talking about that because they don't understand the when. Most of them don't understand the when. The guys that are out there selling these courses, and I sell a course in consulting too, but you have to be able to separate fact from fiction. The guys that are out there making more money selling their courses than they are in their actual trading, maybe they had a $10,000 or so account and they lost it 8 or 9 times. They're trading at 200 to 1 leverage. That's why they lost it 8 or 9 times. So all of a sudden they put the pieces together. You know, if you can lose, statistically, you could lose 8 times in a row if you have a large enough sample size of trades. It's highly likely that as day traders, we're going to lose 6 times in a row a couple of times during the course of the year if you're trading a couple of times a day. You're going to have a statistically large enough number of trades that you're going to lose 6 or 8 times in a row. There was a study done, 2 of the best traders in the world both had 25-year careers, and each one of them in their 25-year career had 13 losing days or trades in a row. 13 in a row. So those are not black swans. Those are statistical, probabilistic events that will happen. If you trade long enough, you're going to get 6 losers in a row. You're going to get 8 losers in a row. You're going to get 13 losers in a row. I myself have had 13 losses in a row. Now, some of that, as we're getting started, we're going to lose 13 times in a row. Maybe 8 of them were legit losses, and the rest of them are just because we're doing stupid shit, right? But look, if you can do 8 wins in a row, you start with a $10,000 account at 200 to 1 leverage. You're trading 20 full lots at a time, and you make 40 pips each time at 200 to 1. You're in 6 figures, just from a statistical probability that you did something. And then you're going to come back and you're going to sell a course on your setups and your indicators and all the cool things it is that you used or you think you used in order to make that happen. It has nothing to do with it. A lot of those folks don't understand that they got in a statistical good run. Now, if you trade long enough, you finally figure out what not to do, and you start losing a lot, and you figure out how to trade, and whether you can describe that right or not, probably not. Very few people can, because they don't have the technical background that someone like myself does. They can step back from the thing and look at it and see what's really going on. The only language they have to express what they're doing is, I have this setup pattern. But really what they're looking at is a much larger picture and assimilating all of that available information so that they can say, this looks like a good time to go in. How do I describe that to my subscribers? How do I describe that Because if I can't describe it, nobody's going to buy my course. Nobody's going to think I know what I'm doing. That's why I don't have a very large subscription rate on my video channel, because people go, well, you must not know what you're doing because you don't use these indicators and tell me when I should be getting into these trades. I'm trying to teach you how to trade. Everybody else is trying to teach you how to use freaking indicators that have no correlation as individual units to what you should do right now. Every indicator that's out there, Bollinger Bands, engulfing candle patterns that are being matched up with a trend line or a moving average or a RSI, that's all shit that happened in the past. A moving average is what happened in the past, averaged over the periodicity of that moving average. If I have a 21 period moving average on a daily chart, that is the average of what happened over the last 21 days. Jesus, in the currency market, you can have a 2-day 300 pip move. I've seen a 1 hour chart go 300 pips. And what does that do to your analysis, if that's what you're doing, is using those indicators? It has nothing to do with the volatility that's happening around non-farm payroll, for example. I mean, so in my video that I did, there are no Forex trade setups. I got a lot of criticism. I mean, it wasn't nasty criticism. It was very well, and I really appreciate you guys sending the emails and engaging with me in the conversation on that, because it's a great topic, and I think it's a wonderful opportunity for me to really get in with you that have done the emailing as to don't be relying on these indicators and all this other stuff everybody else is talking about. They just simply don't have the terminology in order to use to show you what they've done. I mean, what am I going to do? I'm going to show you my chart in live trading, and I'm going to say, oh, it went over this level, and so I'm going to go in. It has nothing to do with going over the level. It has to do with the price action in general, with everything that's happening, not only from a technical standpoint, but what causes the technical things that are going on. It's the fundamentals. You know, in my videos, I don't use fundamentals. I don't. When I do, I end up losing thousands of dollars. Because though I know what the fundamental is and what should happen, and it will happen, I don't know when. So if I'm looking at a position right now, and I'm saying, oh man, these guys just jacked these interest rates beyond comprehension, and the other country's economy is falling apart, and this pair is going to go down for sure, yeah, but we don't know when. So if you go in your short position right there, you could see 200 or 300 pips against you. And you think, oh, I don't know what I'm doing. The thing is that you should have said, I don't know when I'm supposed to do this. I got in, it's going against me, I'm out. That's how I lost 22% of my bank last year, 2022, at the end of the year. I was looking at economic conditions, certain that those conditions would manifest themselves. So certain that as the price moved in my favor, I backed the truck up and loaded in. And when I had a retracement against me, and it started to come back, I loaded up more. And then it just went, and I got stuck. Now, that was at the end of 2022. If I would not have exited that position, I would have paid capital gains taxes here in the U.S. on well over $100,000. I mean, that's, you're looking at a $50,000 tax bill. So if I take the loss, I didn't lose, I made 40, at the end of the year I made 46% against my risk, even taking this horrendous loss. But I saved myself $40,000 or $50,000 in taxes that I would have had to pay, and then still after the first of the year, that never recovered. It never came back. It just kept right on going. Now, since then, as I've been sitting on the sidelines watching all this stuff, it's come around, and prices have come back 400 pips from as far off as it went. I didn't ride that all the way up to there, but I took my loss before that because I just said, this is stupid. I'm not going to take a tax. I'm not going to pay taxes on this shit because it may not come back. And then I've paid the taxes and I've lost the money. Holy crap. You don't want to be in a situation like that. I just wasn't thinking at the end of the year. I had this great vision because of the economic conditions that I was reading and that there was this tremendous setup right there. I didn't answer that question. When's this going to happen? I never ask myself when something's going to happen. And you know why? Because I'm a day trader and I don't care about that. I always say, this is what should happen. I don't know when it's going to happen, but because I know it should happen, and its starting price action has the starting characteristics that it's going to do that now, I'm going to get in and I'll take 10 pips or 20 pips. And if it goes against me, I'm out with a short stop. That's the way I roll when I'm thinking and I'm doing good stuff. But Ed, who sits up here on my left shoulder, whispering in my ear to do stupid shit, I'll get into one of those things and it'll go against me and I'll go, oh, no, this is just this might be a 20 or 30 pip reaction against me. I'll hold it. Oh, well, no, it hasn't. Maybe this is a regression to the mean thing, and I've got another 20 pips to go before it bounces out the 55 period moving average, and then it'll bounce and come back. And it goes up another 40 pips. So I'm 60 pips out, and it didn't do that. Oh, well, that's on the 1 hour bounce, and it didn't bounce off the 1 hour. I'll go up to the 4 hour chart. Well, I've got another 60 pips before it bounces off the 4 hour. But I'm pretty concerned now. I've got so much invested in this thing. I'm 60 pips down. I'll just let it go. Now I'm 120 pips down, and I'm sucking the end of the exhaust pipe. That's what happens when I listen to Ed, who sits on my shoulder, whispering in my ear to do stupid shit. Don't have an Ed sitting on your shoulder. Have some basic rules and understand that the indicators are they're not going to help you. That was all past action. And to try to use those past action indicators and call something a setup, I hope you see, is invalid entry analysis. I don't teach that crap. I would never do that to somebody. It's very difficult to teach trading to somebody who wants to know what parameters to use when they're using their Bollinger Band, or how valid the RSI is, or stochastics. It makes me crazy. I had one guy that was trading in the stock market, and he's trying to trade the currency markets like you trade the stock market. He just didn't get it. So now, I was talking to him the other day, say, how's it going? Oh, I'm down 60%. I've lost all the money I made last year, and I'm down another 40% on my solid bank. Man, I don't know what to tell you. And it's just, you just really have to think. What is it that price could do at this particular point in time? It could go up, it could go down, or it could flatline and continue to go straight. So what is it going to do? Well, the next tick, it's 50-50 as to whether it's going to go up or going to go down. But in the long term, it's either going to trend up, it's going to chop, or it's going to go down. How do you balance those two things? That's trading. That's trading, not setups. I'm sorry to be so. I mean, that's just the way it is, okay? So those of you that email me again and let me know whether I've clarified that for you or whether you want me to take another stab at this, because I'm just trying to make it clear as to how I'm using my terminology and where I get the justification for the crazy things that I appear to be saying. And they're not crazy. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.